if your home has $200,000 in equity, should you use that money to buy another property? Or is that the fastest way to put your primary home at risk? Right now, in South Florida, there are thousands of homeowners sitting of massive equity gains. And the main question people are asking, should I use my home equity line of credit, also known as my HELOC, to invest in real estate? Well, in this video, I'm going to walk you through the good, the bad, and the ugly in real estate and how you can make a wise and not an emotional decision. So let's dive right in. Before we go deeper, I just want to take a moment to say, if you're a homeowner, if you're an investor, or if you're just someone trying to build wealth here in South Florida or pretty much anywhere, this channel is really for you. I just want to break down real estate investing. I want to break down personal finance. I want to break down real estate in just a simple English, just getting all the stuff out, all the fluff, all the fear tactics. I just want to be clear, simple, and straightforward. So please take a second and subscribe. I appreciate it. Leave a comment. I appreciate that as well. And just let's talk about real estate. Let's talk about real estate investing. And if you're planning to use your home equity line of credit to invest in real estate, leave a comment. Let's talk about it. All right, let's get into it. I kind of mentioned it already, but the first question that we have to answer is, what is a HELOC? Right? We have been mentioning this name, and I'm sure I've heard it in many different places, but what is a HELOC? So essentially, a HELOC is an acronym for a home equity line of credit. A HELOC is a revolving line of credit. A HELOC is backed by your own home. It usually has a variable interest rate, and that is interest rate only during your draw period, at least most HELOC. So you can think about a HELOC as your own personal credit card, but your house is a collateral on your HELOC. So if your home is worth $600,000 and you owe $350,000, you may have access to a portion of that $250,000 in equity, right? And here's where it gets powerful. Leverage can build wealth, but leverage can also multiply risk. So now that you have a simple understanding of what it is, let's talk about where it can actually make sense. So let's really go deeper into the good, the bad, and the ugly that I talk about. Let's start with the good and when it can be a smart strategy to use a HELOC. But I wanted to be clear about something, regarding the HELOC. A HELOC, using a HELOC to invest, is not a reckless move. It's not something that is invented in social media. This is a powerful strategy, and it's used every single day. It's used by experienced investors. It's used by business owners that have some extra money, right? This is used by developers everywhere. It is often used by high net worth individuals, and they use it as a strategic, leverage to, what they have. So, banks use leverage, corporations use leverage, real estate investors, they use leverage too. So when it's done correctly, it can dramatically exaggerate wealth building, and that's why it's so powerful. But it has to be done correctly. Let's break down when this tool becomes a powerful tool. Number one, it becomes powerful when you're buying a cash flowing investment property. This is really where the HELOC shines most, right? When you use equity, from one property, from one appreciating asset, and you use that asset to acquire another income producing asset, then you're turning a dormant equity into active capital. Right. So let's say you own your home, and let's say you own it for 7 to 10 years here in South Florida. And let's say your value of your property has appreciated, right? You have paid down your mortgage. You're sitting on $150,000 to $250,000 in equity. That equity is doing nothing for you. It's just sitting there doing nothing. But if you take part of that, let's say you take $80,000 out of that and you use it to to buy another investment property, a duplex or a triplex, something that cash flows. Now you really are activating your equity. Look at the scenario. You have a HELOC, as I mentioned, you use $80,000 worth of your equity, and you see a property that is priced at $400,000. Right. From that property, the rental income is $4,200 a month. And the total amount of expenses in that property is $3,200 a month. So you're now your cash flow is $1,000 a month, and that's $1,000 a month that covers the HELOC. Covers the interest on the HELOC. It covers the maintenance and reserves. Right. It builds additional equity in the rental property. And here's the part most people miss: you still own your primary home. And now you're building equity in two properties at the exact same time. That's beautiful. This is how many investors move from having one property to having three properties, to having five properties, to having 10 properties, of course, depending on how much money you have access to. Now you're not just saving forever, but you're using control leverage. And this is not gambling, this is capital development. Now, that only works if something else is true. Which leads me to the second piece that you really, really need to know. And that is, you have to have a clear exit strategy, when using a HELOC. A HELOC is not a long-term fixed rate debt, right? That's not what a HELOC is for. It's flexible, it's adjustable, it's designed to be used strategically. That's what it's there for. So that means before you ever borrow a dollar, before you ever consider using a HELOC, you already know a few things. You know how you're going to pay it off. You know when you're going to pay it off. And you know what happens if your first plan doesn't work. Investors who use HELOC wisely, they typically do one of three things. One, they use it in short term for acquisition. Then they refinance into fixed debts. They use it for renovations to force appreciation, again, to refinance, and they use it to secure opportunity quickly. Then they pay it down aggressively. So let's say you buy a distressed duplex for $380,000. You use $90,000 from your HELOC. With that $90,000, you use $60,000 to pay down, for the pay down to the purchase. And then you take the other $30,000 for renovations. After all the renovation is done, the property is going to appraise at $470,000. Now you can refinance, pull out the capital, pay off the HELOC. You have selected, you have to recycle your equity, and this is a smart strategy. This is a strategy that is used by disciplined investors every day. But something is very important as well. The strategy was clear before the purchase, not after. The refinance wasn't a hope, it was part of the plan. Leverage without an exit strategy is risk. Leverage with a defined exit is a strategy that is structured. That's what you want. And that leads to the third pillar, which is so important because none of this works without stability. So you have to have a strong financial stability. This strategy is not for someone, barely managing their current mortgage. That's not for you. It's for someone who already has a stable income. He has a healthy credit. Someone that has an emergency reserve already set aside for emergencies only. For someone that has a controlled consumer debt, right? So you should have at least 6 months of personal expenses already saved, right? You have to have a separate reserve for investment property. For investment property, not for your personal investments, right? So the margin in your monthly budget is important that you have it. Why? Because investing should really not threaten your peace. It should expand your opportunity. When someone has financial stability, a HELOC becomes a tool, not a lifeline. And that's the difference, right? A strong investor don't use HELOCs to survive. That's really not what you want. They use HELOC to scale. Proverbs 21:5 says, the plans of the diligent leads surely to abundance. To abundance. Notice the word, diligence. Not the plans of the rush, not the plans of the emotional, not the plans of the reactive, the plans of the diligent. So when equity means discipline, wealth can grow intentionally. So it is a powerful tool. So, everything we talked about, all of this about HELOC, that's how experienced investors use HELOC. Strategically, deliberately, with structure. But here's the part that nobody posts on Instagram. That nobody brags about. Nobody talks about the months where there's negative cash flow, right? Nobody shows the refinance that didn't go through. Nobody explains what happens when rates move against you. Because leverage is powerful and power is neutral. It will multiply discipline or it will multiply poor decisions. So before you assume this is the right move for you, we got to talk about the bad. The bad is where people really, really get burned. And I don't want that for you. So here's the truth. Most people don't lose in real estate because of the math. A lot of people lose because they make assumptions. So don't do that. Don't use it for, using it for speculations. Speculations like, prices always go up or rates will drop soon or I'll refinance later. Hope is not a strategy. Don't do that. If rent softens, if vacancies increases, if insurance jump again in South Florida, that tends to happen, can you still carry it? Can you still carry the debt? Don't do that. Let's talk about the variable interest rate risk. HELOCs are usually variable. $100,000 borrow, you have a rate that is at 5%. Well, the monthly payment would be $460. But if your rate jumps to 8%, then your payment becomes $666. What if your rate jumps to 10%? Then now your rate becomes $833. That switch alone can erase profit. In South Florida, where insurance and property taxes matter, this is real. The bad, thinking about, having just crossed collateral risk. If the investment fails, your primary residence is tied to it. Your home that you have worked so far to it is tied to it. This is not just about a rental property. This is about your family's home. And that deserves some serious respect. Let me interrupt your video just for a moment, just to say, if you are considering investing in real estate, whether you're buying a property or maybe renting the one you already own, or maybe converting the house you live in into a rental place, or if you're thinking of anything in real estate and that you need a realtor, I'll be happy to be that connection for you. Call me. My information is in the comments below, also is in the description as well. I would love to have a strategic session with you just to brainstorm and to see where you're at and how we could work together, achieve the dream of financial freedom that maybe you're thinking about. So thank you for the moment. If you have not done so, please subscribe to the channel. I would love to be part of your world as we continue to impart information to you. Thank you, and let's get back to the video. So we have to talk about when you should not use a HELOC. That's as important as when you should. So we have to slow this down. There's times that you should, there's times that you shouldn't. Because this might be the most important part of this entire video, what to do, but also what not to do. There are seasons in life where leverage truly makes sense. And there's seasons where leverage becomes pressure. Here's when you should not use a HELOC. You should not use a HELOC when you don't understand the numbers. If you don't fully understand cap rate, if you don't understand cash flow, if you don't understand debt service coverage ratio or operating expenses, insurance volatility, then you're not investing, you're guessing. And in South Florida especially, numbers are not simple. insurance premiums can jump, property taxes can adjust after the sale of the property that you're buying. Your HOAs can increase. Maintenance is real, and it's we live in a humid climate. It's maintenance issues are going to happen. Forget that. Count on that. If you're not with confidence, break down what monthly rent is. Have truly understand what vacancy assumptions are, what the repairs cost might be, what your capex reserves are, rate increases scenarios. If you can't do that, then just pause. Just take a break before you get excited about HELOCs, because before leverage comes literacy. So, meaning, if you don't understand what I just said, if you don't understand anything of this thing that I just mentioned, I'm not saying, I guess I'm not saying necessarily at this point, don't do it, period. I'm saying make sure you become educated about it. Make sure that you truly are working with someone that knows how to use a HELOC. Maybe someone that has used a HELOC. Maybe ask your neighbors that they're homeowners, but they have to be experienced, not just somebody that happened to get lucky, but somebody that you could sit down and explain to you what each one of these things are or is, and explain to you how can they affect your decision. So you found a great property to buy that's going to make you a lot of money. Does the numbers tell you that? Or you're just assuming that? The numbers actually say, yes, you're ready, because if that fails, you're not going to lose your home. If that, the market changes, you're still going to be above water. So at this point, I am saying, build your knowledge base. Let's go to school. That's what we're here for, to learn. So that's why the second reason, or the second time, or whatever, that you should not use a HELOC, or when you should not use a HELOC, that's really when you're already financially stretched. If your current situation looks like this, right? If you already have, high credit card balances, forget it. If your monthly income is already tight, it's right on the margins, forget it. If you have no emergency fund for your own personal property, then forget it. If you have variable income, if you have, if you're already stressed around bills, a HELOC would not solve that. It would simply amplify it. Remember, a HELOC is not free money. It is borrowed money secured by your home. If something goes wrong with the investment, you still owe the HELOC payment. And now your primary residence, your home, is tied to that decision. That's heavy. Don't use a HELOC when you're trying to rescue a deal. Just don't do that. This often happens when you find a property, fell in love with the property. Oh my goodness, going to make a lot of money with this property. But the numbers don't quite work. And you say, well, let me put some more money out of my equity. Let's make this work with my equity money. Just don't. Stop. Leverage should strengthen a strong deal already. You have a strong deal, use your leverage for that. Not a weak deal. You don't want to patch a weak deal. If you need you need to borrow extra money just to make the math look decent, then the math is already warning you this is not for you. Don't sacrifice yourself for a deal. Maybe you already have the money, find a better deal. Another time when you should really not use a HELOC is when you're reacting to headlines and what the market is saying, and how the market, and we know the market moves in cycles already. So right now there's a lot of noise. Prices are going to crash, and so many channels that just want to scare you that prices have been crashing for I don't know how many years and still have not crashed. Some of you are sitting in the sideline waiting for prices to crash, and it's still not crashing. Since 2008, 2012, 11, 2015, prices are going to crash. Still not crashing. The math has to speak for itself, right? Last video talked about, spending time in the market instead of trying to time the market. This is similar to that as well. So be careful with what the market says and just focus on the math. So that's just an important one. So yeah, prices are going to crash. Same thing. Rates are about to drop. right? Because of whatever's happening in the government. Inventory is surging. You hear that a lot as well. This is your last chance. Just people been trying to scare people all the time into investing their money, and of course, bad news sells. So don't panic, don't make decisions, don't make an investment decision on emotion. That's dangerous, especially here in Miami-Dade. Property taxes refresh after purchase. Remember that. Insurance is unpredictable. Remember that. Flood zones matter. HOAs can significantly affect your cash flow. Do not use a HELOC because you're afraid of missing out. Fear is not a strategy. Wisdom is, knowing the right numbers is, but not fear. Pause, slow down, relax, look at the numbers, walk away before it's too late. It's important that you walk away before you lose everything. Right? It's better for you to lose a deal than for you to lose your home. Your home is stable. That's solid. That's a strong foundation. Don't risk anything on your home. So I am saying yes, use HELOC. Yes, but only when it makes sense that you're not risking what you already have. You have a strong foot on the ground, just a strong step in your financial freedom, in your financial plans, in your financial strategy. Don't risk that. In other words, don't use HELOC if you don't have an exit strategy. Before using HELOC, you have to answer this question. Is this short term? Am I refinancing out? Am I selling afterwards? Am I holding to this property long term? What if refinances rates are higher than expected? What does that mean to the money? If your answer is, I'll figure out later, if that's what it is, then you don't have a plan. And that's risk. A HELOC without a definite exit strategy, is like driving fast without knowing where the brakes are. You don't want to do that. Right? First thing you find in your car is your brakes. HELOC is the exact same thing. Your exit strategy matters. Another reason is if you're one of those people that you're gonna just lose sleep over the decisions that you make, over the personal decisions that you make, then HELOC might not be for you. All right, this one's personal. If taking on this leverage would truly create anxiety, create tension in your household, make you check rate every week, it's going to keep you up at night, that matters. Financial decisions should bring clarity, not chronic stress. Proverbs 3, 5, and 6 reminds us, trust in the Lord with all your heart and lean not on your own understanding. That doesn't mean avoid risk. It means seek wisdom, study, learn, get prepared. Peace is often a signal. Pressure is often a warning. Heed to that. The bottom line is this. Leverage magnifies everything. With leverage, you can magnify your profit, your growth, your momentum. But with leverage, again, it also magnifies your loss. It can magnify your stress. It magnifies your stability, especially if you're in a high cost state rate like most of South Florida is, right? If the foundation isn't strong, don't stack weight on top of it. And of course, I'm talking about your financial foundation as well. So there's no shame in waiting. There's strength in discipline. Now let's talk about the ugly. This is what nobody talked about. We have talked about the good, we have talked about the bad, and this right here, this is what most YouTube videos won't tell you about HELOCs. Example, let's stress test this scenario. You borrow $120,000 from your HELOC. $120,000, that's a lot of money. And you use it to pay down on an investment property. Everything looks fine at first, but then the market shifts, property values drop by 10%. And in South Florida, that could happen. So a $600,000 property can easily drop to $540,000. That's your 10% right there. That's 60% in value, gone. At least on paper, right? You still have the assets. But now combine that with rent that softens by $300 per month, insurance that increases another $200 per month, and your HELOC, the rate adjusts, and they never really adjust downwards. They tend to adjust upwards. So let's run the math now. If your HELOC, if your HELOC rate can climb from 6% to 9% on $120,000, at 6%, that's $600 a month. At 9%, that's $900 per month in interest. That's a $300 increase. Now your rental income is down, your insurance is up, your HELOC payment is higher, and suddenly your cash flowing investment is costing you another $700 to $1,000 per month out of your own pocket every single month. That's the part that stings the most. You still owe the HELOC, you still have to pay that back. So even if the investment struggles, even if the property value drops, even if you can't refinance, you still have to pay the HELOC back. Second example. This is the refinance trap. Let's talk about that. Let's take this another scenario. You use your HELOC to fund your BRRRR. That's a strategy. If you don't know, again, we'll have another video for that. You plan to renovate. You plan to increase the value of your property. You plan to refinance, and you're going to pay off the HELOC. Simple strategy. But what is after the renovation? The appraisal comes in lower than expected. You expected $500,000, but the property appraises at $460,000. Now, the bank won't, lend you enough to pay off the HELOC, so you're stuck with a new mortgage, the HELOC balance, 2 payments. And now your primary residence is still securing that second debt. That's what I call the refinance trap. It doesn't happen because people are reckless. That's not really why the trap happens. It happens because, markets don't always cooperate with projections. And that's important. Hence, before you make any purchase, you really have to know the numbers and have a team around it that could help you understand what those numbers are on that particular property. The psychology pressure is what most investors don't calculate. And this is important for your peace of mind again. Pressure changes behavior. When payments feel tight, you delay maintenance, you underprice rent to avoid, having a vacancy. When that feels tight, you avoid the necessary upgrades for your property. When money feels tight, you make emotional decisions. Financial pressure creates reactive decisions. Reactive decisions reduce long-term wealth. So when your primary residence is tied to the equation, the weight feels different. This isn't just about numbers. It's your home. It's your family. It's your stability. That's peace. Don't risk that if you don't have to. Know your numbers. Another truth that nobody talks about is the equation illusion. Equity feels like cash. It's not cash. It's borrowed money backed by an appreciating asset. And appreciation is not guaranteed short term, especially in cycles, especially in high cost states. If values flatten or dip for 2 to 3 years and you're highly leveraged, you don't just lose appreciation, you lose flexibility. And flexibility is wealth. So yes, over time, real estate has shown that it always increases, but that increase can take years. That's not guaranteed every single month. So now, after hearing that, my thing, I'm completely against using HELOC. Just to be clear, I'm really, really not. And here what separates wise leverage from dangerous leverage. One word: control. That's it. And that leads perfectly into this next section that I want to talk to you guys about. And that's just having a smart strategy. That's it. Instead of maximizing your HELOC, instead of betting big on appreciation, there's a more disciplined way to use equity. And I just want to talk about that. Just want to slow down again and just talk about that. Instead of just, again, maximizing your HELOC, use a smaller portion of your HELOC. You can partner with another investor. You can use HELOC only for the rehab. So save to buy to purchase a property and use HELOC for the rehab part of it, and pay it off quickly post refinance, or simply just wait. Sometimes wisdom is just having patience. We're building generational wealth. We're not building weekly wealth, or no. Time has to be on our side. We're not chasing speed. We want to just make strong, solid steps in our financial goals. So let me give you my professional perspective. In my experience, just helping families, helping investors, and working with people here in South Florida and other states that I've lived as well, growth must match your stability. A HELOC can be powerful if you run your numbers conservatively, you account for insurance increases, if you stress test for higher interest rates, if you have reserve. If not, it becomes an unnecessary risk. You don't need it, and trust me, you don't want that stress either. It's just too much. So 5 questions that you have to ask yourself before thinking about using your HELOC. Number 1, can this property survive if rates go up by 2%? Do I have 6 months of reserves? What is my exit strategy? Am I investing or am I gambling? Would I feel peace carrying this risk? If you can't answer with confidence, pause. There's strength into strengths. Let's get your numbers together. Let's say some more. Let's find a better deal. You could do it. Just do it right. Don't let real estate become a stressor for you. Let it be a blessing in your wealth building strategy, in your wealth building investment strategy, in your wealth building plans, in your future plans, in your exit strategy, not only for HELOC, but for your career and your creating passive income, if that's what you plan to do with real estate. Whatever the case might be, you said for you, make sure it is not against you, right? $200,000 is a great number. Depends if that's something you have to pay or is that something that you have on your side. The $200,000 does absolutely nothing. It means nothing. What it gives meaning to it is what it's doing for you or against you. So make sure that all the decisions that you make are for you, not against you. So to end, listen, using a HELOC to invest, if that's what you want to use it for, is not good or bad. It's just powerful, and it can be powerfully good or powerfully bad. Power needs to be handled with care. If you want to go deeper into calculating whether an investment property actually flows, I recommend you watch this video that I talk about. This video. I always forget. This video, watch it. Buy your first investment property without fear, because leverage, equity is important. You must understand the numbers. If you are a first-time investor, that video will show you how to actually start. Tell me in the comments, will you use your HELOC to invest? Yes or no? Subscribe if you have not done so. Thank you so much. Over 300 people have subscribed. We are building this channel slowly, this community slowly but surely. I want to do this just for you. So thank you. If you have not done so, help me. I give you content. It will help me if you just hit subscribe and like and share this with anybody that is thinking about using their HELOC. I work here in South Florida as a real estate investor. I would love to work with you. So that being said, I'll see you in that video or that video. Bye.